By the end of this video, you will understand the basics behind intrinsic valuations, why I love using them, and why you should consider using them and looking at stocks too. How's it going, world? Michael EJ here, helping you become the best investor you can be, so you can reach those financial goals and dreams. If you're new to the channel, what is up? Mainly talk about stock market tips and tricks that help you differentiate yourself for the market. My mantra is, if you want to beat the market, you must think differently than the market. So if you want to think differently, subscribe to this channel, like this video, and let's get started. So, we're talking about intrinsic valuations here. I just did a video maybe a couple of days ago talking about value multiples, why they're so popular, why people usually use them when looking at a company. But I actually don't like value multiples that much, mainly price to earnings and EV to EBITDA. I'm cool with price to sales, I'm cool with price to book, because I can easily understand if the multiple is justified. Those other ones, I can't. Because you have to realize, the valuation of a company is driven mainly by growth and risk. So you can't get a clear sense of growth or risk by just looking at a multiple relative to whatever you want to put it towards, the industry itself or the market itself. Multiples change as sentiment change. There's different reasons that drive multiples. So if you really want to get a glance as to what growth and risk is, you need to compute it yourself. You need to put it all together yourself. And the best way to do it is through intrinsic valuations, because you have to determine what growth will be in the long term. You have to determine what the risk of the company is. And most importantly, you have to determine how much needs to be reinvested to create the growth and how risky is that reinvestment. That's the third piece that you just will not see inside of a value multiple. It's part of Oswald the Motorin's teachings. I am a big fan, and he has this value triangle in which he says there's three parts to a valuation. It's growth, risk, and reinvestment. People always forget about the reinvestment. You have to understand how much you're going to reinvest to create growth in a company. And is that reinvestment, does it take a lot of reinvestment, or doesn't take that much reinvestment at all? There's good growth and there's bad growth, and you have to be able to determine that. Now, in looking at these intrinsic valuation methods, there's three out there. Well, there's more than three. I'll start with the big kahuna, the main one that's used, and that's the DCF, discounted cash flow method. And essentially what it states is that the value of a company is the future cash flows adjusted for opportunity costs. That's essentially what the value of a company is. Now, it's really down in the weeds. It's really down because you have to not only understand the income statement of a company, but you also need to understand the balance sheet. You don't understand what is being invested in. So you have to, that's an extra layer that you have to understand. So a lot of value multiples really just depend on the income statement, and you only project 1, maybe 2 years out. With the DCF and with other intrinsic valuations, for the most part, you got to go out further. You have to go out further. Usually 5 years. I use 10 years. Most people might use 10 years. You could even go further, for example, startups. I mean, when I looked at Snapchat a long time ago, and when I looked at Shake Shack a very long time ago, I mean, I was looking at 15 years out. I mean, that's the only way I can make the numbers kind of work and really see the company. So that part scares people, but the numbers are never going to be perfect. You just need to get an idea of what the company might do. So that's how you determine value with the DCF. And it does always come down to cash, right? So that's the best one for that. You also have something that's called GGM, the Gordon Growth Model. Now, it's not talked about a lot. It's very useful if you want to do a quick valuation on more mature companies. Companies that are well established, all the assets are mainly in place, like your Coca-Cola and Walmart types. In that the value of the company is what cash flow will be next year, adjusted for long-term growth prospects and opportunity costs. It's a really easy equation. It's one simple equation, and actually the equation is used within the DCF in the long term. That's a complicated subject I'm not going to touch on today. I'll probably have a different video talking exclusively about the DCF, but for now, just keep in mind that the Gordon growth model is actually, in a lot of times, involved in the DCF. So just remember that all times. Now let's take my valuation method, PVGO Valuation Framework, which is actually a play off the Gordon Growth Model, in which my argument is connected to both the DCF and the GGM, in that the value of a company is those future cash flows adjusted for risk. But how do you determine what those future cash flows will be? Valuations are mainly connected to growth. So how does your long-term growth prospects look? How great are those? What are you worth today if you're not going to grow anymore? Like your no growth value today, plus what you may be worth tomorrow based on your growth prospects. That looks at not just the quality of the growth prospects, how long-term it is. There's different things to consider. So that's how I determine the value of a company. You know, what are you worth today and what could you potentially be worth tomorrow based on growth? It's a different way of viewing everything else. And I'll talk a little bit more about that in discussing all these other different valuation methods. Intrinsically, there's a few other ones. You have the you have the dividend discounted model, DDM, in which it's essentially a higher level or lower level, depending on how you do it, part of the DCF. If you're going to do it correctly, you have to do a typical DCF, and then you have to add a layer of, if the company has debt, how they're going to pay down debt. And then the extra layer of that is, are they going to take on new debt? Or, I mean, what's that going to look like? So you have to understand the company usually a little bit more. And then after that, from paying down debt with the free cash flow, how are they going to pay out dividends? What's the payout ratio going to be? So that can be an extra layer, but most people just look at dividend growth over the past couple of years and just project that forward, and they look at dividends. It's really good for dividend stocks, and you can make it really simple or really complex. There's no in between with the DDM. Another one that became popular in the 90s is EVA, Economic Value Added. Now, the premise of economic value added, kind of similar to PVGO, is that you have to look at the value of a company today, but instead of using just general growth prospects like I do, they look at economic income, and that's just net operating profit after tax. So what economic income is going to be in the future adjusted for risk. Once again, something else that's similar to maybe PVGO, similar to DCF, and once again, better for more mature companies. When you do it on more mature companies, they look amazing. And when you do it on companies that are just younger, they look horrible. So that's why I'm not necessarily a fan of EVA. It's a similar case with cash flow return on investment, CFROI. If I'm not mistaken, that's something that Credit Suisse uses in a lot of their research. And it's really good because you essentially are calculating the internal rate of return on assets that the company has today. Like, that is amazing. You kind of walk through the steps to try to understand what's the return I'm gonna get on these assets that are in place today. The problem is when trying to look at growth, and growth drives a lot of valuations, CFROI doesn't do the best job either. So once again, something that's better for more mature companies with assets already in place, CFROI. So if you want to look deeper into that, you can go to Credit Suisse website. They might have some methodology about it. I could have sworn they had a book about it. So you can look into it, but CFROI, DDM, EVA, GGM, and to an extent the DCF, they're all made mainly for more mature companies. Companies that have a lot of assets there, a lot of tangible assets that you can clearly see. And what differentiates the PVGO from everything else is, that's not the case. I pay more attention to intangible assets. Like I'm gonna make a video talking more about PVGO in the future, and the purpose behind it, and actually how to do it and use it in your valuation methods for companies. But for now, just know that that's the differentiator. But also keep in mind, in all of these, you get to understand what the growth will be. You will determine what the growth will be in the company. You have to come up with the story. You get to determine the risk. How risky is the company? There's going to be a video about risk. I'm going to make one of those soon. And you get to determine how much reinvestment is needed to grow and how risky is that reinvestment. And you get to clearly see those things that you can't see in a value multiple. And that is what I have for you all today. Guys, always remember, you need to understand for any company, the growth and the risk of it, of the company. You gotta understand those two parts and really understand what it will take to grow. What's the reinvestment needs of a company? If you wanna take it to the next level, intrinsic valuations are the way to go. Start off with the DCF, and once I teach you a little bit, look at the PVGO. Michael EJ here, helping you reach your financial goals and dreams by becoming the best investor you can be. I'll see you at the next video. Peace.